Get your free copy of the complete tutorial at www.teachucomp.com/free.
Safety ratios indicate a company's ability to repay loan debt. The debt-to-equity ratio and the debt coverage ratio are the two ratios used to determine safety. The debt-to-equity ratio shows the ratio between liability funding and equity funding. This ratio is calculated by taking the value of the total liabilities and dividing it by the value of the total equity. When calculating this ratio, it is common to include loans from owners in the equity calculation rather than in the liability calculation. Generally speaking, the higher the ratio, the greater the risk to lenders. Most lenders have credit guidelines and limits for the debt-to-equity ratio. A result of 2 is a commonly used upper limit for small business loans. Having too much liability debt is a signal to lenders that you may default on loan payments. However, having too little liability financing may mean that you are managing your assets too conservatively. The debt coverage ratio indicates how well your cash flow pays your debt and indicates the company's ability to handle additional debt. This ratio is determined by taking the total net profit and dividing it by the total liabilities. This ratio will show how much of your profit is available to repay liabilities. Lenders look at this ratio to determine if there is adequate cash available to make loan payments. Most lenders have various limits for the debt coverage ratio when lending funds, so make sure to find this out from your bank or financial institution.
Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.